Welcome, everyone, and thanks for joining us today for this first session of our 2020 International Council program. We're excited to be here today and have some fantastic speakers who I will turn it over to shortly. This year's International Council is being adapted to a virtual format, as are all of the IMF and World Bank meetings this October. And we have a wonderful slate of sessions scheduled throughout the week, so please check out our website, and we hope that you can join us for some of those additional sessions. The theme of this year's program will focus on how to rebuild the global economy and strengthen the multilateral system post-pandemic. I also want to thank Morgan Stanley, who helped make this year's program possible as one of our sponsors. And once again, I want to thank our speakers for joining us today, who will be providing us some timely insight into the role of central banks in fighting global crises. Before I turn it over, just a few quick housekeeping notes. We will reserve some time at the end for audience Q&A. If you have a question, we ask that you please enter it into the questions pane of the control panel. You can send those in at any time. We'll collect those, and then once it's time for the Q&A, I will unmute individuals so that you can pose your questions directly to the speakers. If you're having any audio problems with your microphones, I'll just read your questions out loud. And finally, if you want to join our live Twitter conversation, please use the hashtags and Twitter handle listed on screen. I'll just quickly introduce Bill Dudley, who is going to be moderating our conversation today. And Bill is currently at Princeton University and formerly served as the president and CEO of the Federal Reserve Bank of New York. And as many of you may know, Bill recently took on the role of chairman of our very own Bretton Woods Committee, and he's been instrumental in spearheading really exciting transition time for the committee. And you may have seen the announcement that we just published prior to this, where we announced the newly formed Board of Directors and Advisory Council. And I'm also very pleased that both of our speakers are on this new leadership team as well. So I want to thank you all for committing your experience, your expertise, and your energy to the Bretton Woods Committee. And we're very excited about what the future holds for our organization. So Bill, I'll turn it over to you to kick off our conversation.
Okay, thanks, Emily. Well, we're very fortunate today to have absolutely two extraordinary people who know more about central banking than I'll ever know, Janet Yellen and Lorenzo Benismaghi. Let me start by introducing Janet, who is a good personal friend of mine. I had the pleasure of working with her for my 11.5 years at the Fed, but her career at the Fed extended far beyond mine. Not only was she the vice chair of the Board of Governors, president of the San Francisco Fed, she was also a governor. So her career at the Fed is absolutely without precedent. And in addition to that, she was the chair of the Council of Economic Advisors under Bill Clinton. And on the side, she had a very accomplished career as an academician at the University of California, Berkeley. So welcome, Janet. Lorenzo Benismaghi, currently a chair of Societe Generale. Early in his career, he was on the executive board of the ECB. That's when we got to know each other. Numerous positions before that, including at the ECB, within the Italian government, Bank of Italy. And he's had a tremendously impressive track record of public service. And I'm sort of curious what it's like now being on the chair of a private financial institution. So with that, let's begin. I'm going to start with Janet. Let me pose an introductory question for you to sort of dig into. We've seen extraordinary responses by central banks around the world in reaction to the coronavirus pandemic. Compared to the great financial crisis, I think it's fair to say that central bankers responded more quickly and more aggressively. So how do you assess that response? And do you think the response has been appropriate? Do you think the central bankers have done too little or have done too much? And what are the limits to what central bankers actually can do in this kind of circumstance? So Janet, can you start?
Pleasure. It's nice to be with you, Bill. Thanks for those lovely remarks. Well, the Fed moved very quickly and forcefully in March to stabilize financial markets, and I would rate its interventions as generally successful. It swiftly eased monetary policy. It served as a lender of last resort to the broad financial system. It served as a market maker of last resort to keep the Treasury and corporate bond markets functioning, and it undertook a role beyond anything it did in 2008 by serving as a lender of last resort to the non-financial economy. The pandemic induced a massive flight to safety, and the Fed's interventions averted huge asset fire sales that likely would have spread contagion throughout the financial system and into the real economy, and impeded the flow of credit to households and businesses. Without these massive interventions, the economic damage resulting from the pandemic would have been far worse. Massive selling of Treasury securities by central banks and hedge funds was severely impairing functioning in the Treasury and MBS markets. These key markets became illiquid and dysfunctional. The Fed's interventions did restore order, but it is very sobering to realize how large the interventions were that were needed. There were outright purchases by the Fed of Treasuries and MBS amounting to over $1.5 trillion in the space of about 6 weeks. The secondary credit market facility, I think, served as an effective backstop for corporate bond markets. That was a completely new facility. Its mere announcement succeeded in bringing down credit spreads, which had spiked, and it's kept that market open for new issuance. The central bank swap network also served to support dollar lending abroad and to reduce volatility in dollar-based markets. No financial institution failed, and credit remains widely available, at least to larger companies. I would rate the joint Fed Treasury emergency facilities to support lending to smaller businesses, that's the Main Street lending facility, and to state and local governments as less successful. The terms of the loans that are available through these facilities were established jointly by the Treasury and the Fed, and they're simply not generous enough to incent much borrowing. I think that reflects both limitations on the Fed's tools and authorities, and importantly, the preferences of the Treasury. Well, you asked also what powers should be in the Fed's purview and what should lie outside the Fed. And I would say, starting with the Fed's emergency facilities, if a facility requires fiscal backing, it should not be in the sole purview of the Fed. And a number of the facilities that were set up do require fiscal backing because the Fed requires adequate collateral to prevent losses, to protect itself from losses. I think it's appropriate for these facilities to involve Treasury participation and ultimately the backing of Congress. I would argue that the Fed's normal lending powers really need to be expanded. Central banks were created to serve as the lender of last resort to the banking system. But in modern times, so much intermediation occurs outside the banking, outside of depository institutions, that to serve this function, the Fed needs to do more than lend to depository institutions through its discount window. At a minimum, it seems to me that the Fed should be allowed to lend to broker-dealers, namely to investment banks, on a normal basis. The bank holding company parents of the broker-dealers are now all supervised and regulated by the Fed. And although the Fed has, both in 2008 and in this crisis, set up a facility, the primary dealer credit facility, to lend to these investment banks, it's better to have a standing facility than one that may or may not appear on an emergency basis. I would be reluctant, though, to establish standing facilities to lend to shadow banking sector institutions that aren't subject to prudential supervision and regulation. And although that's another topic entirely, I think these entities do require greater supervision and regulation because, as we saw in the crisis, they're a source of systemic risk. Let me just conclude by saying more broadly, central banks just should not be the only game in town. They have an important role to play, but fiscal policy also has an important role to play, and that's been obvious in the case of the pandemic. Chair Powell has been continually emphasizing that central banks cannot give grants to businesses or households in need. They cannot spend on testing or provide help to state and local governments through grants. And given the lags and the impact of monetary policy and the constraints from the effective lower bound, central banks sometimes can't support aggregate demand to the extent that's necessary. Let me stop there.
I think you're right, Janet, that right now there's a risk of disappointment that the Fed, if we fall off this fiscal cliff, the Fed isn't going to be able to make it right because it's not something that they have the right toolkit to address. Let me turn to Lorenzo.
Well, first, thanks for inviting me. On the issue of the effectiveness of monetary policy, and I'm looking more at the European side, I would also agree that with Janet that monetary policy has been quite effective. And I think there are three main reasons for that, in particular in Europe. I think the first one is that fortunately, central bankers have learned from experience, in the sense that just looking at the monetary policy instruments, compared to 2008, they decided basically to adopt a full range, a full panoply of instruments, rather than trial and error, or starting with the most obvious one, which is cutting rates, and then moving to the next if it doesn't work. I mean, I remember in 2008 when I was at ECB, we cut rates and then we realized it wasn't enough, and so we changed some of the instruments, like giving the fixed rate full allotments, so giving unlimited credit to the banks, and then moving to other, and it took a lot of time to innovate. I think this time at least ECB really did a lot of things at the same time, so it took the market by surprise to some extent, because rates were already negative, and we know, and there is a discussion that maybe going further negative is not efficient, but it also implemented policy like restarted QE with more flexibility. In Europe, the ECB purchases assets, government bonds with a certain proportion for the different countries. Here, the weights for the different purchases changed. There was more flexibility, so that was a key element. I think the speed and the diversity of the actions. I think the second element for the effectiveness of monetary policy is that in fact fiscal policy has also acted more quickly. If you remember, in 2008 we had to wait the London G20 summit, and where there was some coordination. Here really fiscal policy felt responsible, also in Europe, although everybody was happy in Europe that monetary policy was doing its own part, but they had been lectured by Mario Draghi and then recently by Christine Lagarde that fiscal was necessary, and the kind of excess saving world in which Europe is living or was living made monetary policy not that effective without the support of fiscal policy. And indeed, fiscal policy came in quite early, I think, in Europe in three ways. First, the suspension of the Stability and Growth Pact, which was an important change with respect to 2008, where in fact, countries had the ability to increase their deficit, but they always had to come back at a certain point to the 3%. I think here the idea that you don't have to come back immediately creates an incentive in the market, or the expectation in the markets that fiscal policy will be there to support the economy. The second element, which was very important in Europe, is the public guarantees provided on bank lending. I think this helped credit growth to be strong, and the transmission of monetary policy was strengthened through these guarantees. And the third element, of course, is the agreement on the next generation EU, which is the first issuance of European debt, which of course supported the policy action in different ways, incidentally, but it certainly created the expectation of a supply of assets, of safe assets, that in this environment where there is not only a real shock, but also a financial shock, where there is a run towards safe assets, the fact that Europe was there to provide for these safe assets, I think, was an important message. And then a final difference, I think, is more of a political environment, or a general environment, institutional environment, in which monetary policy acted in Europe. First, it's the first time that we have a crisis without the fear of some countries exiting the euro. So the combination of political commitments, the next generation EU, but also the commitment, for instance, by Germany to become an even greater creditor within the European budget, I think reassured markets that there was a willingness to overcome this crisis without a breakup in the Eurozone. I think this is not an issue anymore, while it was in 2011, 2012 in particular. The second one is that I think the ECB made it clear from the start that whatever it takes was there. There was some initial communication problem, but I think it was clear that the ECB would play its role. And third, we have to remind that the ECB is also the single supervisor, and so was able to use some of the non-monetary instruments, more of the regulatory and prudential instruments. Maybe we can talk about it later. I think reassured the markets that the sovereign bank doom loop would not reemerge again, and that the numbers provided on the stress tests, on the statistics on core tier 1 capital, were more or less uniform across the union. While you remember in 2010 there were some doubts that national supervisors were really treating their own banks in the same way. So I think the institutional environment was more European, more determined to support monetary policy, and this, I think, provided monetary policy with a stronger support to do what was needed to be done to support the economy. Now, of course, the question is, will it be enough? Maybe we can discuss this later. But I would say this time around, Europe was better equipped, more European, if you want to say, quote unquote, to address the crisis, and this made monetary policy more effective.
No, I think that's right. I mean, my very short take on it, and what I'm hearing you saying is, one, the coronavirus came on much more suddenly, so you needed a much faster reaction. Number two, you had a lot of tools that were already on the shelf that you'd invented during the great financial crisis. I heard both of you say that. And the third thing I think is important that maybe you didn't mention is the villain was different. During the financial crisis, you had large financial institutions getting into difficulty, and so reacting to that and coming to the rescue of those institutions, I think, was a lot more difficult from a political economy perspective. This time you have a pandemic. The coronavirus is the enemy, and so it's a lot easier from a political economy perspective. I didn't hear any criticism of the Fed or the ECB really in terms of any of their actions. So there, the political support for what the central banks have done has been pretty extraordinary this time, and that was not the case last time. If either of you care to comment on.
No, I mean, I don't want to say, as a banker currently, I cannot say that banks are part of the solution rather than part of the problem. Around, it's a nice line, but it's true that, using monetary policy to help the financial system only or primarily was a major handicap in the previous crisis, not only for monetary policy, actually also for the Treasury to support fiscal policy. This time, monetary policy is there to help the whole economy, and the banking system is really channeling, and you can see it in the statistics. I mean, in Europe, we are, I mean, the TLTRO, the so-called TLTRO, so the lending to by the ECB to the banks is 1.8 trillion euros. So it's a huge amount, which is lent to the economy. So people can see that, and they can see that this is coming to the real economy. So the whole political view has changed dramatically.
Janet, do you want to jump in here?
Yeah, sure. I agree very much, Bill, with what you said about the difference in the political economy this time versus 2008. In 2008, the financial sector was seen as the cause of a terrible downturn in the economy that was costing people their jobs and their homes and their retirement savings. And this time, the fact that the banks were strong, they really didn't encounter stress, that reflected a decade of work to strengthen capital, liquidity, risk management, and that it's a pandemic. It wasn't something coming from Wall Street. That led to much broader support for the interventions that the Fed did. I think the fact that the Main Street facility hasn't been successful and a gap has opened up between plentiful funding for larger corporations, now even including corporations that purposely levered themselves up before the crisis, and small businesses, really many of them are starved for credit. This may begin over time to generate ill feelings toward the Fed and toward the Treasury, but it is a very different situation than it was in 2008.
So let's dive a little deeper into all the things that the Fed did. So you generally are pretty supportive of what the Fed did, but you singled out the Main Street lending facility as not very successful, and the amount of take up there has really been quite de minimis. Do you think that's a design issue, or do you think that's because the diagnosis of the problem was incorrect? In other words, my take on the Main Street lending facility is it's basically providing Fed balance sheet to commercial banks, but if commercial banks don't need balance sheet, then it's not really the right tool. Can you talk a little bit about what things do you think from the Fed worked the best, and what worked the least well, and why, and what lessons should we draw from that?
Yeah, well, I agree with your diagnosis on the Main Street lending facility. It is extra balance sheet for banks. I mean, as you know, the Fed just doesn't have the capacity to do direct lending to small businesses. So it had to find an agent to evaluate lending risks and solvency, and it turned to the banks. To avoid moral hazard, it was important to ensure that the banks had skin in the game. They don't have a lot of skin. They only have 5% skin for the loans that they originate, but that's still enough that they don't want to lose money. And while I don't see any sign now that the banks are short of capital and curtailing credit to the economy because they face capital insufficiency, they just don't want to make bad loans. And, this is a situation where we just don't know how long this pandemic is going to last. It's unclear whether or not businesses will be solvent and viable at the end of it. Arguably, grants rather than loans are necessary. You know, Congress allocated $450 billion to support these facilities. And I believe that was scored as though they were going to lose all of it. And clearly it was Congress's intention to pump a lot of credit out into the economy to the firms that would be affected. But this design problem and the Treasury's apparent desire not to see losses occur in these facilities. I think the municipal lending facility suffers from the same problems. It's expensive and it's difficult to access. So there is a difference there. But I think the other facilities, and of course, you know, the fact that the Fed had all the term sheets that you and Ben and our colleagues put together in 2008 could roll out commercial paper facility, a money market lending facility, the primary dealer credit facility, and others, the TALF, really enabled more to be done more quickly.
Taking that same question to Lorenzo, what do you think's worked best in terms of what the ECB has done, and what you think has maybe not been as effective as hoped?
Well, I think if I have to evaluate and judge ECB, I think the fact of having acted on different fronts, for the interest rates, there was little room, but still, I mean, you know, banks can borrow at -1, and there is a spread that they can use. So that was an important signal. The collateral was broadened. QE was implemented not only on treasuries but also in other the so-called pandemic facility was implemented with a flexibility. Now, of course, the institutional context in Europe that I described earlier as more European, so more supportive of the policies that have been implemented, is always a bit complicated. So in the middle of the pandemic, we had on the 5th of May, the judgment of the German Constitutional Court about whether the ECB was not going, I mean, that was referred to QE, of course, which started 5 years earlier. So, you know, legal issues come always with some delay. But reminds us, of course, what are the limits of monetary policy, and is monetary policy doing too much? Are central banks overstepping their mandates? Are they taking into account all the collateral damage, potential collateral damage that can be done with interest rates? I think the reaction in Europe to these constitutional court judgments were very cold, but the issue is still there, and of course, how far can the ECB go, and how far can central banks go in an environment where you may like it or not, but we are going to live in a world of excess savings over investments. And the key problem that I see is that in the end, and Janet has mentioned this, ideally, I mean, if you want to really accommodate the demand for liquidity and try to help the economy, you should buy non-liquid assets instead of buying liquid assets, because US treasuries, bonds, or even Italian BTPs have become very liquid. So you are substituting money with quasi-money. I mean, maybe in my old days, we would use these terms. Which is not, in the end, very effective, and the only result is to increase this excess of liquidity. What central banks should do to accommodate is to buy less liquid assets. But of course, is it the role of central banks to take over in this kind of environment a credit risk which may transform monetary policy to a fiscal policy if things go wrong? What's the guarantee that central banks can have? And I think this issue will become relevant, especially if there is some debt restructuring, if there are losses in the central bank. Can the central bank continue in this policy, and what backstop does it have from fiscal authorities? This would be, in my view, the question going forward, especially if we realize that continuing to buy bonds and government bonds is not going to be a big game changer down the road.
So let me ask both of you this question. What authorities do you think that the ECB and the Fed should have that they don't have, versus what authorities do you think they have that they shouldn't have, if any? Is there something missing from the Fed's toolkit? Is there something missing from the ECB's toolkit that's important, or are there things that they can do that you think are actually a little dangerous?
I guess I'd point to two things. I already mentioned, I think, having broker dealers have access to the discount window, an authority on a regular basis, an authority they don't have. I think the Fed should have the authority, or ideally would, although I understand it's politically controversial, to buy a broader range of assets. And actually, Ben and I, in an op-ed in March, suggested the Fed should have the power, as the ECB and a number of central banks do, to buy corporate bonds. I think that would make quantitative easing more successful. And the other thing, when you say what powers should the Fed have, I really have to say that although I'm very pleased that no particular financial institution encountered undue stress, the restriction that was incorporated in Dodd-Frank on the Fed being allowed to lend to prevent the disorderly bankruptcy of an individual institution, that really worries me, and I would like to see it go away. So the kinds of loans that were made in 2008 to JP Morgan Chase to acquire Bear Stearns, or the AIG bailout, are prohibited. Broad-based programs, and we've seen just a huge set of them, and clearly they're effective, and Congress is not saying the Fed can't do anything. But if there were a particular institution that came under stress, I can certainly imagine that it would be important to be able to address those problems. And the deal in Dodd-Frank was, we're taking this tool away. We're very concerned about moral hazard. Congress created an orderly liquidation authority by which the FDIC could come in and resolve a systemically important non-bank. It could be an investment bank, even that's part of a bank holding company. It could come in with resolution authority. But wow, I would not be anxious to try this out. We worked pretty hard my last couple of years in the Fed to plan globally. The Bank of England, the ECB was involved. What would we do if a major financial institution with global operations was encountering insolvency? Could we manage that over a weekend? And we did a lot of work planning how that would occur. But I'm really glad we haven't had to try it. At best, and the living will process in the United States, there have been changes in the organization of major banking organizations that I think definitely make them more resolvable. So maybe if there were a single systemic firm, it encountered, for idiosyncratic reasons, large losses, and we had to try this out, fingers crossed, perhaps it would work. But the idea of doing that in a panic situation, where financial panic, I really don't think that that's workable at all. So that's something I see as a problem.
How about, same question for you, Lorenzo? What additional powers would you like the ECB to have, and are there some authorities that you think are not appropriate for a central bank?
I would distinguish two dimensions. One is the powers which are currently in the central banking environment, in Europe, but not well allocated between what would be the Federal Reserve Board in Washington and maybe New York in the US or the rest of the system. In Europe, we still have maybe the need to centralize a bit more, and this crisis maybe will lead to that. Partly is linked to the fiscal decentralization, but the fact that we are implementing QE in Europe while the risk is still on the national central bank is a problem, and in my view weakens the effectiveness of monetary policy. There are other issues like, for instance, emergency lending facility to especially to smaller banks. I think in the case of large systemic banks, we have a single resolution fund to which banks are contributing. They're being taxed year by year, and rightly so. That would help in address the issue of capital inadequacy. But on the regulatory front, there are still too many margins for discretion for national regulators. I think it would be better if these discretions would be reduced and centralized at ECB. Having said that, I'm very careful to give the central banks too much power, because this gives the political authorities maybe the idea that things get simpler because it's the central banks who deal with them, and this increases the risk of being the only game in town because they deal with everything. And I'm a bit concerned about the Fed getting into addressing income inequalities and other issues which are very important for our societies. But if you put that burden on the central bank, then there is an overburdening by definition and risk for society.
I think there's a bit of a risk that the central banks are viewed as almost more powerful than they actually are. They can, like for example, the United States, you hear the criticism for the increase in income inequality, and there's sort of this presumption that somehow the Federal Reserve can do something to solve it. But monetary policy is a very blunt tool, and I think it behooves all of us to educate people about what monetary policy can and maybe can't do. Let me turn to a question that's different this crisis than last time. Last time we actually saw coordinated monetary policy easing. Some of the central banks all doing it at the same time. This time we didn't see that. What do you should we take? Is there any message that we should take away from that, or is it noteworthy? And the second part of my question is there anything the central banks could do to coordinate more closely that would help support the global financial system beyond what they're doing right now? Janet, you want to start?
Sure. It is definitely noteworthy that there were no joint statements by central banks or by the G7 or by the G20 during this crisis of the type that we had in 2008. But the swap lines were activated. Central banks did more or less the same thing. They pulled out all the stops to provide support to the financial system and to their economies. The fiscal responses we saw in the Euro area, in the US, in most major developed economies were huge and went beyond anything that actually occurred in 2008, although in 2008, there was G20 coordination and statements about determination to work together to provide monetary and fiscal support. So it's not that action was missing, it's that there was no symbolism of cooperation around it. And I suppose it reflects a kind of generalized breakdown that we have seen in economic cooperation among the world's leading economies because of the US's America First policies and withdrawal from participation in global institutions. America First, I think, has led to a decline in trust. The US certainly hasn't as far as I can see, tried to take the lead in generating a coordinated response. But as both of you know, central bankers are a close-knit club. They meet in Basel. They actually have very strong working relations. I can't imagine how many phone calls there must have been among central bankers about what to do for the crisis. I think there was quiet coordination, but there wasn't the symbolism of we're working together to address a crisis.
Lorenzo?
Yeah, no, I fully agree. What was missing was a nice communique, I guess, which would have maybe, you know, increased even further the action of central banks. The reason why there was no communique, I mean, probably it's a political issue. But if you look at the result, I would say there was coordination by emulation. You know, every week, you know, the ECB would say, "Look, the Fed did it. What are we going to do?" And then probably it led to doing the same thing. And if I have to look at an indicator of coordination or non-coordination, it's the exchange rate. I mean, back in 2008, you remember the dollar came down from 160 to 130, then back to 150 in just a few months. Here, we have a relative stability of exchange rates throughout the crisis. The dollar is just slightly dropping, but it's nothing comparable to the shock that happened in 2008. So, as Janet said, there's been probably a lot of phone calls, a lot of actions. The sharpness of the crisis led everybody to do the same thing. But I think looking forward, maybe you know, we should be concerned if this coordination was really not there, and at some point was not supported by some statement to the markets and to the global economy that, you know, that we are here to work together to solve the problem. So hopefully this coordination will be shown more openly at some point.
I mean, I think the central bankers are certainly in favor of coordination. I mean, all the trips to Basel and standing up the foreign exchange swap lines, that takes coordination. That doesn't just happen automatically. You have to work, you know, negotiate a lot of terms and conditions to make that real, and it only works if both sides want to participate. I'm going to turn to Janet with a question about the U.S. So, Fed Chairman Powell recently announced landmark changes to the Fed's long-term monetary policy framework. So, a couple of questions about that. Why are these changes being implemented? Do you think they're important? Do you think they're going to be helpful in ensuring financial stability? Do you think these changes are going to, you know, change the nature of the business cycle and the trajectory of interest rates? What should we make of this?
Okay, let me take a stab at that. The main motivation for changing the framework was to adapt it to a world in which the effective lower bound on interest rates is increasingly a constraint. And the reason it is increasingly a constraint is because of the downward drift we have seen over decades in nominal and real interest rates. And Lorenzo referred to this. In the global economy, we have a lot of saving and growing weakness in investment, probably reflecting such things as weak productivity growth and labor force growth and aging populations. And so estimates of the neutral real interest rate have now drifted down to around 0.5% in the United States, and similarly for Japan, the euro area, in some cases even lower. With a 2% inflation objective, that means the normal neutral level of short rates in the US is 2.5%. That's well below post-war averages, closer to 4.5 or 5. And it means the Fed just doesn't have much room to address downturns in the economy using its conventional tool. And of course, the Fed and the ECB and the BOJ and others have deployed unconventional tools, asset purchases, forward guidance, and they've been helpful in dealing with the constraint, but the constraint remains very important. And the problem with a constraint is that if the tools simply aren't sufficient when there's a downturn, it's very likely that inflation will undershoot the 2% objective after downturns. Look at the United States. Last decade, inflation's averaged 1.5%. Now, if the Fed just shoots for 2% after such a period, which is what the existing framework implied, 2% is ideal. It doesn't matter what happened in the past. We let bygones be bygones. Then you have a world in which some reasonable share of the time, the effective lower bound is binding, inflation averages less than 2, and the rest of the time it's not binding and it averages 2. Well, that doesn't average to 2. So inflation expectations will likely fall. The more they fall, the more the level of nominal interest rates fall. In the original problem, interest rates too low, no room for monetary policy to operate, just gets worse. And I guess we now call this syndrome Japanification. And the objective of this new framework is to prevent those kinds of dynamics. And the key piece of it is the Fed has said, after a prolonged period like we've just been through, in which inflation is averaged under 2%, it will consciously try to shoot for more than 2% later on. It's going to follow a makeup strategy rather than a bygones be bygones strategy. It's to be a temporary overshoot, not a permanent overshoot. The Fed hasn't stated how long it wants to overshoot, but clearly it wants inflation expectations to remain anchored at 2%. The practical impact of the policy is that during recoveries following downturns when inflation has been too low, which is the situation we're in right now, the Fed is promising to let the US economy run really hot, to wait to raise short-term rates until the labor market is really tight and inflation is on track to overshoot 2%. And that's been incorporated in the Fed's forward guidance. And so we're looking now to a world in which interest rate setting will follow a strategy sometimes called lower for longer, that when there's a downturn, central bank will be quick to lower interest rates to 0 and to keep them there longer than any standard monetary policy rule will recommend, and then to gradually raise them back to normal levels. Yes, let's see, what about financial stability? I think we will have better, if it's successful, better macroeconomic performance on average. And I suppose that's positive for financial stability in the sense that long, deep downturns and inflation drifting down, even outright deflation, is a negative for the financial system. But on the other side of it, there is a concern, I have a concern and others do, that running the economy that hot and keeping interest rates that low for that long could touch off credit booms, asset price bubbles, and developments that are risk to financial stability.
Thank you, Lorenzo. So the ECB has said that they're undertaking their own monetary framework review. It hasn't been finalized yet. What should we expect?
Well, I mean, the ECB has started later its strategic review, and it will be impacted. I mean, it's going to be impacted by the Fed announcements, I think. which maybe are not easily transferable to the European framework. I have to say that I share some of the concerns that Janet mentioned, and I'll mention two or three. The first one is transparency, because it's not clear if you are below 2% for a number of years, how long you're going to be above 2%. And it's not clear if you can really control the inflation rates when you are above the 2%, and if you commit not to raise rates, because you can get easily into a situation where you get, inflation accelerating and inflation expectations being disanchored. So the transparency, accountability element, in my view, is problematic, and financial markets are looking very closely at, and of course, maybe not right now, because inflation is not going to pick up very quickly, but it could become an issue if you get closer to 2%. Then I think there is an issue of time consistency, because suppose you do what you say, then you get a 2, a 2.3, 2.4, then and you are committed to stay above. I mean, at a certain point, it doesn't work anymore. You have to start tightening, and maybe you have to allow even inflation to be below 2% for some time to compensate for the period above. So I'm not sure that this, of course, the Fed already mentioned that they will revise every 5 years, but I'm afraid that this is the doorstep to changing too quickly. And then, as Janet mentioned, the risk of financial stability. If you don't raise rates for a long period of time, even though inflation moves up, just because you're shifting your target toward employment, then it means first that you are, maybe fueling bubbles. Second, it means that you're easing monetary policy, not that you're not tightening, because if inflation goes up and your interest rate keeps unchanged, your real interest rate goes down, in fact. And so you're becoming more accommodative as inflation goes up, then suddenly you have to tighten. And if you want to catch up, given that you have been behind the curve for some time, you have to catch up quickly. And then unless markets are well prepared, you may have a shock. And then, if you look at the experience over the past 1994, or, you may remember, even the tapering, then you don't want to shock the market, and you may want to slow down. And so it could create some financial instability, which in my view is quite problematic. So, and finally, I think there is maybe too much trust in forward guidance. I'm not sure that markets really buy out. They want to see actions. I think what we are really missing is an analysis of the role of monetary policy in a world where you have excess savings, and what does it mean for the balance sheet of central banks? If the economy does not produce enough assets to satisfy the savings that come from all over the world, what is the role of a central bank? Can it control inflation that easily just by moving interest rates, or by? I think we need to think more about that, and I hope the ECB is going to think about that, because I'm afraid these solutions are not final ones. I think we will live with low inflation quite for some time because of this excess of saving, and coordination between fiscal and monetary policy may at some point have to come back on the discussion, respecting, of course, the independence and the different processes for deciding, but these issues have not been tackled entirely.
Well, it's pretty interesting when you think about the sea change that's been made over the last 30, 40 years. Before, we were worried about inflation, we were worried about fiscal deficits. Now we're worried about inflation being too low. We're not worried about fiscal deficits. So you got to believe that 20 or 30 years down the road, it's going to go back the other way. I'm willing to bet. Let me turn to the fact that the central banks have been so aggressive in terms of backstopping markets. Are you concerned about that this will lead to greater risk taking in the future? If you have a financial crisis and it's once every 100 years, it probably doesn't matter if this central bank comes in and sort of backstops markets. But now we've had the second major intervention by central banks, not in 50 years or 100 years, but in 12 years. And do you worry about this in terms of affecting behavior? The institution will say, well, gee, if things ever get bad, the Fed will bail me out, the ECB will bail me out. Therefore, it's okay to take more risk. That's something we should be concerned about. And if it is, how should central bankers respond to that? Janet, you want to start?
Sure. I think it's a definite problem. I think once you have an emergency like we faced in March, a central bank has absolutely no choice but to intervene. I think those interventions probably encourage greater risk taking, as you suggested, and create a kind of moral hazard, but you can't let the financial system collapse to teach investors a lesson. So to my mind, the right approach is to make these emergencies less likely. We shouldn't be having the need for these kinds of extraordinary interventions once a decade. We need better supervision and regulation. And we saw in the crisis, I mean, we spent a lot of time making safer and sounder in the aftermath of the crisis, and they did well. But where the problems really reside, I think, is in non-banking financial institutions and markets. Hedge funds that are really completely unregulated in the United States, we don't even have good data on what they do. I think they played a role in the turbulence of March. They were, not most of them, but a small number that were engaging in huge basis trades in the Treasury market, faced problems when repo rates spiked. Perhaps they also faced higher margin calls on short sales in the futures market. And suddenly they're dumping, along with others, huge quantities of treasuries. Maybe there should be greater regulation of the amount of leverage that hedge funds can take on. Money market funds. We had runs on money market funds. The Fed had to erect all the 2008 facilities to stop the money market funds from the commercial paper market drying up and the repo market. This was a problem everybody knew about from 2008. The Financial Stability Oversight Council pressured the SEC to deal with it. They did some things, but not what was requested. And the things we worried about, namely telling these money market funds that when their liquidity fell below a certain level, they could erect gates and impose fees. That was part of why we saw runs again. Open-end mutual funds that promise daily liquidity but hold illiquid assets. We knew this could be a problem that would result in fire sales, and indeed that's what happened. And of course it took the Fed coming in and erecting the secondary market facility for the corporate market to stop those runs. So there is moral hazard in this. I think it's necessary to intervene beforehand with appropriate supervision and regulation to deter this kind of behavior.
Lorenzo, same question for you.
Well, I agree, but I wonder whether in the end it's not unavoidable. I mean, these developments are part of a more fundamental structural developments in our economies linked to slower trend growth, lower interest rates, preference for liquidity, demographics, which then crisis by crisis lead to a higher debt, private and public, over GDP. and at some point, at least part of this overall debt over GDP will not be sustainable. And then I can't think of a debt restructuring which starts well and finishes well, and which doesn't require at some point major accommodation by monetary policy. I mean, we saw with Lehman Brothers. I mean, some people said the day after, finally, it's the end of moral hazard, but then somebody had to start addressing the issue and pumping in liquidity. The same happened with Greece in Europe. Finally, a debt restructuring, and then monetary policy after some time had to come in. So I think it's part of a stage of our capitalism where wealth has become so huge, but this wealth is the counterpart of debt from other parts, and some of this debt is not sustainable. So it requires an adjustment, which requires an adjustment in wealth, which produces major effects on the real economy. And policymakers have to do something about it. They cannot just say we don't care. And this leads to a totally different type of volatility in the markets. Low volatility for a long period, then strong adjustments, then again low volatility, stop and go in terms of intervention by central banks. So crisis prevention is key, but I wonder to some extent whether we have not created a system in which in the end we are not fueling this system where debt is the key asset instead of stocks. We all want safe assets. With the prudential regulation of insurance of banks, we want the system to be safe. And then it's so safe that in the end nothing can go wrong, because if it goes wrong, the systemic dimension becomes huge, and then central banks are forced to intervene. So frankly, I don't have a solution, but I see that the problem is not going to be solved otherwise than by having central banks being involved with their balance sheet in the end. And until the cycle, the long-term cycle changes, and China will be an important actor when there will be a lot of retired people in China that will spend all their accumulated wealth. Maybe we get into a different cycle. Inflation will start maybe rising again, but this could take 10 to 20 years. So again, I don't have a solution, but my fear is that central banks will have to be there.
I mean, the risk obviously is that you're just postponing the inevitable as opposed to avoiding the inevitable. But the good news this time was at least it wasn't the financial system itself that was sort of the cause of the interventions. The cause of the interventions were the coronavirus pandemic. So I think that it should, if we can avert future pandemics, maybe we won't need these kind of interventions. I'm gonna conclude my questions with a tricky one, especially for Janet, because it's about the dollar as a reserve currency. Central bankers don't like to talk about the dollar. They'd like to defer that to the Treasury. The dollar has been the reserve currency for a long time. And my question to you is, both of you, is do you think that's going to be sustained in the future? And to the extent it is, what obligations does that entail for the Fed and for the United States more generally? I'm going to start with you, Lorenzo, this time. You might think that the dollar has an exorbitant privilege and would like to see the role downgraded. So if you could talk about the dollar as a reserve currency, where do you think we're going?
No, I think there are reasons for the dollar being the reserve currency and the dominant reserve currency. The size of the U.S. economy, the depth of the capital market, and the absence of competition for a long time, and then how long it takes to be a challenger. The advantage of the incumbent. I think if you look at historical trends, it's unavoidable that China will become a reserve currency. I mean, the size is there; it's increasing. It's a question of the financial market becoming deeper and more liberalized, and the exchange rate being more predictable. And Europe, I mean, has certainly a challenger. The size of the euro market increased until the 2011 crisis, then it came down. But I think inevitably, and these initiatives in Europe, the new generation, next generation EU, and the more Europe gets its act together, the more it will be a challenger. So we are moving towards at least a tripolar system. It will take time, but it depends also on the willingness of the US to, on the one hand, recognize this trend, and on the second, to still continue playing the role of leader in the global economy. So the longer the US, if the US starts withdrawing from the system and not feeling responsible for a smooth transition to the new regime, the quicker it could happen, in fact, and the more unstable it could happen. So we need more coordination, as we mentioned. We need to accommodate the demand for diversification, and we need to have a cooperation between financial centers instead of competition. So the US still has the key to the answering these questions, and I hope it will use this key well.
Jan?
Well, let me first of all, I completely agree with Lorenzo's comments on this. I just add a couple of things. I think one of the reasons that countries are increasingly frustrated with a system where the dollar plays such a key role is that they perceive the dollar as being used as a political weapon. The United States has been aggressively using sanctions to exert pressure on adversaries. And as we know, it's very serious about deploying its authorities over banks to shut down terrorist financing and illicit payments. And a lot of foreign countries are finding themselves with systems where it's very hard for them to get access to the international payment system. I remember during my term as chair, and I'm sure you had exactly the same thing, many central bankers came to plead from emerging markets that they couldn't find corresponding banking arrangements for their domestic banks, which they need to engage in dollar transactions. And in part, we had a situation where the Justice Department and FinCEN imposed such huge fines on banks for violating Know Your Customer regulations and rules on sanctions. Remember, BNP Paribas faced a penalty of almost $9 billion from the Justice Department and had to temporarily suspend part of its dollar clearing network. And the consequence has been that these big banks are just unwilling, that the rewards aren't sufficient to take the risks of being hit with sanctions like that. So I think one thing the United States needs to do is, and I think it's tried to do this, but there's a ways to go, is to figure out ways to solve this problem, especially for emerging market countries. In addition, when the dollar is used so widely in transactions, you need a lender of last resort. And the Fed provides that to banks in the United States. And the swap lines are very important in extending that lender of last resort, at least to important financial centers on a regular basis. But there are a lot of other countries that aren't part of the swap network that need that kind of access. And the truth is that Congress, they come to the Fed and ask, can we have a swap line as well? And it's very understandable why they want and need that. But Congress certainly has not authorized the Fed to take on such a role. And Here, I think the IMF could play a very important role. I know it's aware of it. It set up facilities that are intended to play that kind of role, easier access to loans for countries that have strong macroeconomic policies, but that's an important role to play as well.
Great. Thank you, Janet. We have about 20 minutes left, and I think we should give our audience a chance to ask a few questions. So we can open it up for questions. That'd be great.
Yeah, sure. Thank you for this wide-ranging conversation. We do have some good questions from the audience, so I do want to turn to a few audience members. And I'm first going to turn to Frank Vogel, who's been a Bretton Woods Committee member for a very long time. And Frank, we'll unmute your microphone. If you could please identify yourself, who you're affiliated with, and go ahead and pose your question.
Hello, can you hear me?
Yes, Frank.
Oh, hello, good. This is a wonderful discussion. Thank you. I'm Frank Vogel. I'm the chairman of the Partnership for Transparency Fund and a co-founder of Transparency International. As we look at the global situation, we seem to right now have a response to the pandemic or the economic consequences of the pandemic that adds debt to more debt to more debt until we get mountains of debt. On the advanced economies, the fiscal deficits are unprecedented and probably rising. When we look at the middle and low income countries, we see that their international external sovereign debt is reaching unprecedented levels. Some of those countries have misused their funds in the past. Now they're getting even more money. As we emerge from the pandemic, how do we deal with all this debt? Are we going to go into a global deflation? Are we going to have a world financial crisis? Or will the central banks come to the rescue and we can all sleep well? Thank you.
Hope we can sleep well. Janet or Lorenzo?
Okay, I'll start off. You know, I'll focus on the United States, but I think the same thing is true for many developed countries. Levels of debt that we once upon a time thought to be high, 80, 90% of GDP, no longer seem all that high because interest rates are so very low. And they're not just low because we have a pandemic and the central banks have responded by cutting rates to zero. They're low for the reasons we've been talking. I mean, that is one reason, but even without the pandemic shock, we're in a world of secular stagnation where there's so much savings and weak investment, and it's driven down interest rates. And so if you think about the burden of debt being partly measurable by the interest burden of the debt. Take I know the numbers best for the United States. In 2007, the U.S. debt to GDP ratio was 35%. By 2019, before the pandemic, it had basically doubled. It was at 79%. The interest payments on that debt as a share of GDP were absolutely flat, absolutely no change whatsoever. Now, the Congressional Budget Office just finished an assessment of the longer-term outlook for the U.S. debt and finances. And they project that by 2030, the U.S. debt to GDP ratio, largely because of all the spending that's occurring now and the weakness in the U.S. economy, it's going to push up the debt to GDP ratio to about 110%. But the projection of the interest burden of that debt is that it's actually for the next several years going to fall, not rise. So low interest rates really makes a big difference. And I guess my assessment would be we have no choice but to use fiscal policy to address this downturn. If we didn't do so, there'd be more weakness that would feed into the deficits and debt as well. And we can afford it. But we do eventually have to have sustainability. Maybe 150% US debt to GDP ratio is sustainable. But then one has to have a situation where the deficits are small enough that the debt to GDP ratio stabilizes. To me, the real problem in the United States is we don't have that. Deficits were very large and not sustainable before the pandemic. That was true 20 years before that. It will be true and get worse after the crisis. That has to be addressed. And, you know, if you look at Japan, my goodness, they have a debt to GDP ratio of about 225%. And you can imagine lying awake nights, many nights worried about that. But they've really succeeded in managing it very well. They've kept their deficits under control. They have a large debt. They're not trying to hold it, to move it down. And interest rates are absolutely rock bottom. There are risks, of course, because it may not always be true that interest rates are that low. But I guess that would be my perspective.
Lorenzo?
Well, I was, as Janet was quoting the US numbers, I was looking for the Italian numbers, which are maybe more striking, because the debt to GDP ratio in the first few years of the 2000s was around 105% of GDP, and now it's projected 160% of GDP. And if you compare the interest burden, it was 5% of GDP in the early 2000s, and it is projected to be 3.5 next year. So you see even more strikingly how the debt burden goes down while the debt goes up. I guess again, if you look at the increase in the debt, I mean, if the world was in a situation where it didn't want debt, there was not enough savings globally, then interest rates would go up. The paradox in all this is that we see an increase in the supply of debt, but an increase in the demand for debt. It's an increase in the demand which comes from excess savings, but also from aging population, the regulations, which leads to higher debt. So how does the supply and demand balance? I guess it's simply by low interest rates. We will live with low real interest rates for a very long period of time. So it's a rentier society, if I can say so, in Marxian terms. Maybe we have to read Marx again, but it's a society where basically, if you want to preserve your wealth, you have to accept that its return is very low, and which makes a lot of people unhappy. I mean, if you're a net saver and you had planned for your pension on the expectation that interest rates would go up, would be high, well, of course, your expectations prove to be wrong. You are accumulating wealth, savings, and you're investing in very low return, and so you cannot expect your standard of life to improve just by saving. And that's the way in which most of our countries and most companies will come out of this phase. Of course, this is not generalized, because some countries will have a rate of growth which may be lower than the interest rate, and so the sustainability of the debt may become a problem. And there, I think that's where my concern is that in that kind of a world, can you really isolate a crisis? And we have seen by experience, I mean, from the Latin American crisis to the Greek debt crisis more recently, it's very difficult to avoid the contagion in a world where you have a financial system which is sophisticated, and people are afraid, of course, of losing part of the world, of their wealth. So that's why I was mentioning earlier that central banks will have to be involved, at least try to isolate the crisis where they will happen. But
I think, Lorenzo, you raise a very good point.
Don't count on your saving for your pension. I mean, at most you can preserve your wealth, not improve it.
I think you raise a very good point that the journey to low rates is sort of fun for financial markets because valuations get pushed up. But once you're at very low interest rates, expected returns from there are going to be actually very low, and they're going to start to weigh on households' ability to save for retirement, pension funds, insurance companies. And we're really now in that era. And I don't think we fully appreciate the consequences of being in that era. That's different than the trajectory down. Emily, can we have another question?
Yeah, sure. I'd like to turn to Helen Zhao. Helen, we're going to unmute your microphone if you want to pose your question. Helen, are you there? Okay, I'll read Helen's question. Helen's on our new advisory council, and she asks, if major central banks keep pumping liquidity and buying assets with the hope of pushing inflation back up, what does this mean for emerging market central banks? Either they choose to ease immediately or resist it. Isn't it unavoidable to have higher leverage asset bubbles?
Renzo, you want to start?
Well, I mean, it's, we have these cycles of, I mean, of course, if this happens, say, in the US or Europe, against vis-a-vis the emerging markets, and of course, the monetary policy at the center of the system, in the US in particular, has a direct impact on the policies in the emerging markets. And typically, an expansionary policy in the US provides some benefits at the global level, because basically you have these carry trades and flows get out of the dollar and try to get into the rest of the world. It's more complicated when you have the tightening cycle, because the reverse of then hits the flow of capital to emerging markets. So I think it goes back to the discussion we had on the new Fed framework, which in this respect scares me even more, to the extent that if monetary policy stays very accommodative for very long, and even becomes more accommodative as the cycle recovers, part of the spillover will go to emerging markets, and then the tightening will be even harsher on the emerging markets. So the stop and go, or the impact of this new policy on emerging markets may be even more destabilizing. Of course, it depends on the fundamentals of the emerging markets, and maybe on the use of what we would call macroprudential instruments to try to stop these spillover effects. But we know that these may not be that effective in the medium term. But that's my concern, at least.
Yeah.
I agree with Lorenzo. I think shifts in monetary policy in advanced countries often have huge impacts on capital flows and exchange rates in emerging markets, and managing it probably does require strong macroprudential policies in the emerging market countries.
So I think we're going to have to wrap it up, because I think our time is almost done. I want to give each of our panelists, Janet and Lorenzo,
you should ask a question where Janet and I can at least disagree on one issue. Otherwise,
so I'm going to give you a chance for any final comments. Anything that you'd like to say that we've missed, or anything that you want to amplify, Lorenzo?
No. I mean, it looks like we central bankers are single-minded. I mean, I tend to always to agree on issues. So I really was trying to look for a provocative question, but I mean, it's difficult for me to originate one. To Janet, maybe I should ask Janet myself. looking at the Fed's new strategic review. How concerned are you that monetary policy gets involved into issues like inequality and other issues which are very important for U.S. society and for our societies in general? But what are the risks for monetary policy, for its independence, and for its ability to? Sorry to conclude with a nasty question.
Question for me. So
You can ask one back.
The Fed has long had a dual mandate, and maximum employment is part of the mandate. And the more the Fed is able to fulfill that mandate by pushing unemployment down to low levels as it had been able to before the pandemic, of course, while keeping inflation controlled. That's the other part of the mandate. That has strong labor market has disproportionate benefits for lower income people. And we actually did see very large benefits, I think, to the bottom part of the US income distribution, and the fastest wage increases at the bottom of the income distribution over the last couple of years before the pandemic tragically turned all of that around. And beyond that, namely trying to fulfill the mandate of strong labor market, which does have those disproportionate benefits. I don't think the Fed or any central bank can be asked to take on income inequality. That's the best contribution that can be made. If there's a suggestion that the Fed is doing more than that, that's a problem.
So Janet, any final thoughts or questions for Lorenzo?
Not really. I think we've really covered a lot today. We have agreed on a lot of things. Central bankers face very complex jobs. Too many emergency interventions have been required in recent decades. And I would just conclude by saying I think we need to strengthen the financial system so that we don't have another crisis within the next decade.
I agree.
Well, thank you both, Janet, Lorenzo. Great comments, very thoughtful discussion. Hope we can do it again in a year, not virtually. That's my goal.
That would be great.
Thank you very much, Emily.
Thank you, Lorenzo. Yeah, thank you, Lorenzo, for asking that question. We did have questions on income inequality, as well as climate risk and CBDC. So we'll save that for the next conversation. I just want to join Bill in thanking our speakers for joining us today. I thought this was an incredibly fascinating conversation. We covered a lot of ground, and excellent to hear your expert analysis. So we'll be posting this to our website in the coming days. I want to thank all of our audience for joining us today. We do have 3 sessions remaining for our International Council this week. The next one will be on Wednesday at 2 p.m. with IMF Managing Director Georgieva, followed by World Bank President David Malpass. So we hope that you can join us for that, for those discussions, and hear their priorities about the post-pandemic economy. So thanks again to our speakers and everyone for joining us. That'll do it.
Thanks.
Thank you.
Bye-bye.
Bye-bye.